Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. In today's video, I'm going to be talking about the SP 500. I'll cover the ASX 200 in a separate video, and I'll leave a link to that in the description section below. And I've also got a graph you need to see to believe. It really is fascinating, so make sure you stick around for that. As always, this is general commentary and doesn't take your personal situation into account. All right, let's jump over to our first chart. And here we have the SP 500 on the screen. And this really is getting fascinating. We now have a market that isn't reacting to bad news. And the big news this week was US inflation. It came out at a 41-year high. It came in at 9.1%, and that's even more than the economists were expecting. They had expectations of around 8.8%. So it really was a very high number. Now I want to go over to the hourly chart, just have a closer look at the price action around the time of that announcement. So this is where the inflation number came out. The market sold off. And so we had that initial sell-off on the inflation news. Then the market rallied back. There was another attempt on Thursday to sell off, but again the market rallied back. And really interesting speculation now about potentially a 1% rate rise at the Fed's next meeting the week after next, so around 9 or 10 days' time. That sort of talk is now starting to circulate in the markets. So the market really did have a big catalyst over the last few days, had a big catalyst to sell off aggressively, but it didn't. So that gives way to the possibility that everyone who wants to sell has already sold, at least temporarily, and potentially takes the downside momentum out of this market. Now, what I want to focus in on here is that we have a clearly defined trading range. I can just draw it in here on the chart. So it's between 3,740 on the downside, and on the upside, we've got an upper trend line, and that comes in at around 3,900. So the market attempted to break down on Thursday, got below this support from these two previous lows. So this was a low in July, early July. This is a low in late June. And often you'd find that below these lows, you find a whole lot of stop loss orders, and also people wanting to initiate a short. They'll put orders to sell once a previous low is broken. So the market did break below those lows, but there wasn't any follow through selling. And in fact, what we saw was, the market rally. So that could have been, this break here could have been the catalyst for a bigger sell-off, but it couldn't get going. And what I spoke about last week, I spoke about a couple of other levels last week. I spoke about 3,700 on the downside. So let's draw that in around there. And on the upside, I said, look, keep an eye on 4,000, because 4,000 marks the top of the Fibonacci retracement region. If we look at this last leg of the decline and put the Fibonacci's on, this is a 61.8% retracement. So I said, look, keep an eye on that level there, and on the downside, 3,700. So last week we stayed within the bounds of those two levels. We don't have a breaking point at this stage, but I think if there is definitely still downside risk on the table, if the market can break below Thursday's low and then break 3,700, well, I think if the market goes back on red alert, that there could be one of those big down sequences where the market loses maybe 200-300 points over the course of a week. I think that downside is, it is still there, and it could re-engage. On the upside, now this range is a little bit more defined. We can say that upside breakouts start happening around 3,900, 3,920. That could trigger a new round of buying. They could potentially see some short covering start to come into the market, and it could push the markets higher. So just coming back to the daily chart, it's look, I think the longer the market sits down around, longer the market sits in this sort of tight range which it's been in, I think the odds start to lower that we're going to see a sharp decline. I think the longer we stay here, the less likelihood that we see that over the course of a week or two. I think that risk starts to, well, I think it is actually starting to dissipate the longer we're in this range. And I think the greater the potential that this becomes some sort of a basing pattern that could potentially support some sort of a higher level. Now, I want to stress, I think it's too early to be trying to call any sort of a final low by any stretch. And when you look at these moving averages, the market remains well below those moving averages. I think there's no doubt about it. You've got to say the primary trend is still down, and the macro outlook remains awful. You look at the interest rate hike cycle, look at inflation, look at the war in Ukraine. It's a really difficult macro environment. But against that, we also need to remember that bear markets also have rallies. Bear markets just aren't about stocks falling in a straight line. Bear markets also have rallies. And in fact, some of the strongest rallies are within bear markets. And so what I'm thinking is maybe the SP 500 is currently setting itself up for one of those classic bear market rallies. And what I want to do, I want to show you a fascinating chart that I saw through the week, which hints to me that this bear market rally scenario could be the one that we need to watch for. But first of all, if you're getting some value from this, please hit that like button and please leave a short comment. Just, hey, thanks for the video. Just tells YouTube that people are watching and people are engaging, and that helps me so much because then YouTube shows other people and helps me grow my YouTube presence. Because it takes a lot of work. It takes about like half a day's work. It's only a short video, but to put all the information together and get my thoughts clear so I can present them to you in a nice, concise and flowing manner, it takes a lot of time. So please do that for me. And please hit the subscribe button if you haven't already done so. That also helps a lot, sends YouTube some really good signals. Okay, so over to this chart I'm talking about. So this turned up in my Twitter feed through the week. I think it's just fascinating. What it's showing the amount of money going into inverse ETFs. So an inverse ETF, it's an ETF you buy when you think the market's going to fall. So when you buy an inverse ETF, if the market falls, the price of the ETF goes up. Now, there's currently a lot of money. Just look at this here. This is the current reading for flows into assets, into ETF assets. So currently $9.8 billion sitting in inverse ETFs. And that's a lot of money which is betting on another sell-off. And it's more so than during the COVID crash, got to $8.5 billion. And just look how quickly that's increased in just the last month. So people have actually been selling the rally. So over the past month, as we know, the market has rallied and has been going sideways. So people have been selling that initial upward part of the move, and then the sideways period they've been selling. And it's also really interesting to look at what's happened at some of the previous peaks. So just have a look at this COVID period, for instance. So there's the peak of 8.5 billion, but when you project that up, that comes in after the low. So it was after the low that people were still looking for the market to sell off again. And I was one of those people. I thought this was during April and May. I thought it was a bear market rally, and people were voting with their money. They were buying inverse ETFs. But of course, as we know, that was after the low. Something similar happened back here in 2016. The peak, when you project it up, was after the market had already bottomed and had turned higher. So what we've got here, the market bottomed about 4 weeks ago, and now we have a high. So it's potentially a sign that maybe the market has gone as far as it's going to go on the downside, at least for now. Doesn't mean there's a final low in place by any stretch, but it does make us wonder, or makes me wonder anyway, is all this short interest and negativity a sign that the bear market rally is close at hand? So let's go back to the our daily chart for a moment, because I think another key piece to this puzzle is the US dollar. So what I want to do now, I'm going to put the US dollar index on this chart. And this is really interesting when we look at it together with the stock market. So what I want to do, I want to highlight 3 key areas, and these are the areas which I want to focus in on now, and they're all the rallies. I'm focusing in on the rallies over the last several months. Explain what I'm doing in a sec. I just got one more I need to line up and draw in, and it's the rally from last month. Now, what you'll notice if you look at these shaded areas is that all of these bear market rallies we've seen have coincided with the dollar index moving sideways or the dollar index pulling back. And all of the falls over the last few months have coincided with the dollar index rallying, these strong rallies, and the markets falling away. What's been interesting the last few weeks, the dollar index has been having a really strong run. You look at it on a dollar index chart on its own, it looks like it's almost going parabolic. Look what the stock market's done during that same period. It's been holding its ground, which is something it hasn't done through previous bouts of dollar strength. And so that gets back to my point from earlier on. The market now seems to be brushing off bad news. It's brushing off higher inflation. It's brushing off a rising US dollar. Does that mean it's becoming resistant to falling right at the time when there's maximum exposure to inverse ETFs? So all those puzzle pieces do suggest the possibility of a bear market rally really is coming into play. And what I wonder, what would happen if the dollar, which does seem to be losing a little bit of its momentum on some of the time frames I've looked at, just on hourly charts. It's quite. I'm not going to try and pick a top in the dollar index. The trend is still in place, but I just wonder what would happen if the dollar started to pull back, or even if it just started to go sideways. Would that be enough to trigger some of the shorts and some of the inverse ETF holdings which are out there? Would some of those start to cover, and could that drive a bear market rally? So I think the potential's there. I don't know whether that's going to happen, but that's one of the things which I'm thinking, one of the things I'm looking at. So what do you do as an investor? How do you handle this as an investor? And as I keep saying each week, I think we need to continue playing defense. I think defense is the name of the game in this market. Yes, there are signs there could be a bear market rally, or let's just say a rally. There's a chance there could be a rally, but if there is a rally, and if it is a rally, I do think it's a bear market rally. Look, I think you've got to be careful, because bear market rallies can draw you in and they can reverse course again. So that's why I think caution is the name of the game. And I'd think twice about having too much exposure to ETFs, so to inverse ETFs. So inverse ETFs can be, look, they can seem like a good idea, but the problem is they can be a costly product when the market moves against you. And bear markets are just notoriously difficult to navigate. So that's one of the things I'd be doing. If I had those inverse ETFs, I'd maybe think about lightening up my exposure, and I certainly wouldn't be coming in putting on new ETF exposure at the moment. I'd be quite hesitant to do that. So look, hopefully that helped. It's going to be an interesting week to see how this plays out. Market's really at a pivotal point. We've got resistance and support on both sides. It's really pinning in now. We're going to get a break one way or the other, and I think the market's going to move quickly when it breaks. So let's hold on and see what happens. So please give me that like. Hope that was fun, and I look forward to coming back, talking to you next week. Until then, bye for now.